Hey everyone, welcome back to our channel, Investo Time. Today, we've got some exciting insights from Chris Vermeulen on the future of gold and silver prices. If you're investing or just curious about the markets, you'll want to stick around for this.
We're seeing this squeeze up. I still think we're going to see gold continue to move up to roughly 2650 and then potentially 2750. So there's still more upside. Obviously, it's getting closer. When it hits that level, I do feel like the main move for gold is over. I think we have another couple of months potentially of higher pricing. I think we're going to see gold, silver, and miners start to pick up speed, and it could actually happen fairly quick. It might not actually be a multi-month move. This might happen in only a couple of weeks. It is primed and ready, and it's about to pop.
Chris Vermeulen, founder of thetechnicaltraders.com and a financial analyst specializing in technical analysis, shares his insights on the future of gold prices. He predicts that gold could rise to around $2,750, although he believes the significant surge is largely over. Vermeulen expects a brief but sharp increase in gold, silver, and mining stocks within the next few weeks. Analysts are also optimistic about gold's trajectory in 2024, with prices potentially reaching $2,500 per ounce, driven by factors like the Federal Reserve's monetary policy, interest rates, and increased global demand for safe haven assets. Looking further ahead to 2025, some experts predict gold could trade between $2,800 and $3,200, spurred by expectations of a Federal Reserve rate cut. Similarly, Commerce Bank is optimistic about the silver market, projecting that silver prices could climb to $30 by the end of 2024, potentially reducing the gold-silver ratio to 72. This reflects a broader belief in silver's ability to benefit from the same economic forces driving gold, with significant gains expected soon. Vermeulen anticipates potential volatility and a 34% pullback in gold during a bear market, similar to what occurred in 2008. Despite this, he expects a multi-year gold rally, viewing gold as a more stable investment compared to silver or miners. He recommends investing in GLD or physical gold. Historically, gold has shown a general upward trend, especially during times of economic uncertainty, such as the 2008 to 2009 financial crisis. For example, an investment in gold from 1972 would have been worth approximately $1,285 in 2007 and $2,166 in 2010, whereas the S&P 500 would have declined by nearly 10% over the same period. Before diving into the video, make sure to subscribe to our channel and hit the bell icon to stay updated with our latest content. Thanks for watching and enjoy the video.
I think it's on the verge. It's squeezing up. Like, we got hit on that big sell-off day with equities. It pulls gold down, which is exactly what you were hinting to earlier. Like, gold, if we go into a bear market and a recession, gold generally gets hit pretty hard. It's not actually a low volatility play during a bear market. It can fall 30-40%. But we're seeing this squeeze up. I still think we're going to see gold continue to move up to roughly 2650 and then potentially 2750. So there's still more upside. Obviously, it's getting closer. When it hits that level, I do feel like the main move for gold is over. I think we have another couple of months potentially of higher pricing. I think we're going to see gold, silver, and miners start to pick up speed, and it could actually happen fairly quick. It might not actually be a multi-month move. This might happen in only a couple of weeks. It is primed and ready, and it's about to pop. So I like gold from that scenario, and we are in the sweet spot when we look at cycles in the markets. Pull that back up here. If we look at cycles, we tend to have gold do very well right near a major market top, and all of these three different groups of stocks and commodities are doing very well. Energy stocks are at near all-time highs. And so all these things are telling us, hey, this is the big scenario. And the weekly or the monthly chart of gold really makes this crystal clear that we had this new super cycle starting in gold. We've had a multi-year consolidation. Well, we had a new super cycle in gold in early 2000. We had a multi-year consolidation. And then here, just before the last financial crisis, we saw everybody move to gold as the defensive play. And that's where we are right now. Everybody's moving into gold for that defensive play. And then I think we're going to eventually see gold pull back just like it did in 2008, which was 34%. As you mentioned, there's volatility to gold during a bear market. It's pretty wild still.
How did
And
you
then we're
come
going to
up
go
with
into a
your?
multi-year rally. So everything is unfolding. You and I have been talking about this for months. We keep updating kind of month after month.
Yeah.
And the chart pattern is just unfolding as expected. There are no surprises here. And I've always been mentioning gold is the best one. Forget silver, forget miners. If you just want a low volatility, high probability trade, something that'll make you money and not make you sweat bullets, just GLD or physical gold is the way to do it. And that's perfect. That's exactly what's happened. Silver is struggling. Miners are still actually struggling. Gold is just letting loose and moving up. So we can use Fibonacci extension. We can use based on this. So there's a few big patterns here. So we have a few different patterns. We can take the low using Fibonacci extension up to this high and then down to this low. And this gives us roughly, I didn't draw it perfectly, but this gives us the upside targets of where price should move. And 2650 area, this next level is the next upside move for gold. So there's not a whole lot more upside based on that. We can also go back from the last super cycle and say, okay, well, based on the last super cycle, which is this is the first leg up, then this is a big bull flag or a big consolidation pattern. And then we have the second half of the leg, which is happening right now. We can gauge where that next move will be. So we can go from the low to this high, and we're going to tie into this low down here. And if you take a look where that goes, that also is around that 2700, depending on where we connect these lows. We're right up into this area. So there's not a whole lot of upside. The daily chart and the monthly chart going back like 20 years are both pointing to the same price level. And what is really crazy is that long-term chart has this orange line right here. This is the 618. And I always tell subscribers, I say, if price hits the 618 and pauses and has a pullback for a while, then we're going to go up almost always and hit that 100% measured move. So once we hit this level, though, this 2700 is right at smack dab in the middle of the patterns. It's like all things are off. Like, who knows? Gold could go into a free fall, pull back 20 or 30% potentially. And then, the market will be falling apart at that point. So that's kind of the scenario that I see unfolding.
In 2022, Chris Vermeulen noted that the dollar index saw a rally of 15% to 18%, with drawdowns of less than 4%. He describes the dollar as a low volatility investment with significant upside potential, making it an ideal choice for asset rotation and strategies aimed at capital preservation and cautious growth. Since late 2022, the dollar has often moved in tandem with oil prices, particularly during supply-driven disruptions in the energy markets. These disruptions create inflationary pressures and limit growth, which in turn supports the dollar. Shandon points out that a potential rise in oil prices to $100 per barrel could further benefit the dollar due to its anti-cyclical nature, increased headline inflation, and higher yields. This relationship between the dollar and oil prices highlights the importance of incorporating these dynamics into investment strategies. Let's return to the interview.
So it's going to depend a little bit on your style of trading. Like, one of the simplest, this is the most simple, most boring position you could be in here, which is bill, which literally it's just an equivalent to cash. You buy this ETF, you get paid a daily interest. And then at the end of the month, if you didn't sell it at a higher price, all that interest is paid out in a dividend payment. So the stock market could be in free fall mode and dropping 30, 40, 50%. And you just move to this and your account goes up every month, every quarter. At this point, you're making like 5% return a year while the stock market goes down. So this is a boring position, but it is a position. A lot of people don't realize the power of cash. Warren Buffett, obviously massive in cash holdings. All kinds of people talk about cash. It is one of the safest plays and one of the best positions when everything is falling apart. I don't care what inflation is. I don't care what else is going on. I would much rather keep my cash and let inflation do a little bit of damage and earn interest than hold something that's going to drop 30, 40, 50%. So it's about preserving capital, reducing risk. So this is one of those plays. I think another play could be the US dollar. I think the US dollar index, now a ton of people are super bearish on it, although they've been bearish on it forever, just like people have been super bullish on silver forever. I still think we're going to see the dollar continue to move up. When we look at it from a long-term standpoint, I think we're going to see this dollar Eventually, when the stock market does start a bear market, the dollar is going to work itself up. And I think we're going to see very strong gains. I think we're in a similar scenario that we saw back in 2000 in terms of commodities being the most undervalued, stocks and real estate being the most overvalued. And when people get nervous, they move to the dollar. It's just that kind of safe haven play. We see the dollar move significantly during bear markets and corrections, moved 25% or so in 2008. It had a big pop and blip during COVID, which was more of a news-driven kind of crazy event. But I do think the dollar is actually still going to be a relatively stable play. We'll have to see, obviously, a lot going on in Japan, the yen, to see how the dollar index plays out. But that will be the other one that I like to look at. The dollar's got great upside potential, and it's very low volatility. In 2022, we saw the dollar. I mean, it had a massive rally. It rallied like huge. Just in 2022 alone, it rallied something like 15 or 18%. And that's what we moved into during 2022 for some of it, while the stock market was falling. And the biggest pullback along the way was less than 4%. So lots of upside, very little downside. It's slow moving. You're not going to wake up down 10% or 5% or 3%. It's a very comfortable alternate asset to move into. And this is all stuff that we rotate through with the asset revesting strategy that I talk about. It's all about managing risk and positions, preserving capital, and whenever there's an opportunity, we move into it to grow.
Some analysts predict that gold could rise to around $2,750 and potentially exceed $3,000 per ounce if inflationary pressures and geopolitical tensions increase. This rise may be driven by growing demand for safe haven assets, which would further enhance gold's role as a crucial hedge against economic uncertainty. Investors should stay vigilant, as such a breakout could lead to extended gains and require strategic adjustments to take advantage of gold's evolving opportunities in a volatile market. How do you think geopolitical events will impact gold prices soon? Share your thoughts in the comments below and join the conversation. If you found this video insightful, don't forget to like, subscribe, and hit the bell icon to stay updated with our latest content. See you in the next video. Thanks for watching,